Hi everybody. Hello everybody and welcome to another webinar of our series. Today we're gonna go ahead and hopefully conduct a live trading session together. This is probably the last webinar of this kind of series that we're gonna do. From New Year's onwards, we're gonna start fresh and we're gonna go ahead and do and repeat the cycle yet again from the beginning. We're going to start doing once again the basic concepts of technical analysis. We're going to visit in the um, fundamental analysis aspects of things as well. We're going to do candlesticks individually and as a cohesion or let's just say synchronous kind of aspect of things. We're going to look at chart patterns. We're going to dive deeper into technical indicators. We're going to do risk management, money management, and all that kind of lovely stuff, all from the beginning. So this one, as I just said, is going to be probably the last one for 2024 before we kickstart the cycle. So hopefully this is going to be a lovely one for you. So this is going to be a live trading session. But before we go ahead and just visit the charts and look at what we have in front of us, let's do a small recap on the agenda, if you will like, what we will be doing in today's session. So let's begin with our approach. So this is a slide, or this is an actual webinar we've done in the past, which is called scenario construction. Super beneficial for us. In order to just put forth, if you like, the basic concepts on in terms of how to approach trading. It's not just a mathematical or a technical kind of webinar. This is for you to understand the rationale of coming up with an actionable trading plan by visiting all those lovely parameters that you have in front of you, making those questions, asking those questions to yourself in order to get much more confident in your scenario of what to do with the day or whatever that is, if you want to trade the day. So you're going to go through a list of, or a checklist of questions that are going to give you these we're going to kickstart, in a sense, a formation of a rationale that's going to help you put your thoughts and your projections in action. Okay, so let's revisit this kind of topic. So this rationale overview that we have proposed or have we introduced in a prior webinar goes like this. So the idea at the end of the day when it comes to trading is to effectively come up with an actionable trading plan. Yes, you might look at different price action, different instruments going up and down. What can you do about it? How can you benefit from this? And this is coming from having an actionable trading plan of the instrument of your choice, and then you go ahead and analyze its direction, possibly spot any areas where there's going to be some sort of friction, so areas of price action that is actually where price action is actually stalling or breaking out from, um, or you can call them as liquidity kind of areas, which are going to be super beneficial. You're going to see how assess the current strength and momentum of the trend. If there is any, remain vigilant about any possible fundamental factors that can distort this kind of picture or impede or possibly accelerate this kind of trend that you have already identified. And finally, come to a conclusion on where a sufficiently good entry point is. Purely subjective kind of point of view here. And again, when you come up with an actionable entry point, you have to think about what is going to be your exit. How much are you willing to make out of that trade? How much are you willing to risk? And yeah, you're going to go through the steps of how you can create this kind of rationale, if you would like. It's going to be calibrated to you depending on what kind of questions you're going to be asking yourself. But at the end of the day is to have a plan instead of randomly going into the market and just buying or selling stuff. Okay, so it has to have this kind of process requires a lot of thinking and a lot of analyzing and a lot of introspection, if you like. in order for you to find something that you seem fit and you seem comfortable with taking action upon. And from there onwards, just execute the plan. For the time being, you'd have to study first, analyze, make a prediction, and then execute. Okay, most people just skip the first two steps or first three steps and just jump straight to the execution. That is not, but basically that's the best way and that's the best approach for you if you want to lose money. Okay, just plain and simple. What you need to do is have a plan, make the, if you like, chaos or the uncertainty as little as possible, and then from there onwards you have to execute your plan uh on a live environment. Okay, so the thinking process must be there in order for you to learn the process. And if you learn the process and if your process becomes effective enough, okay, or accurate enough, then you can expand that into the future. So what we're trying to do here is come up with the rationale or the thinking process or the preparation stage, which is most effective. And once you find out what that is, you're gonna extend that into the future, because if you calibrate as best as you can your plan, or if that plan is accurate enough and you have and you are getting actual results out of it, what you need to do from there onwards is just copy paste that mentality, that rationale onwards, and you're going to minimize unwarranted moves. He's not saying you're going to become a perfect, we're not saying you are going to become a perfect trader, you're going to have a 100% success rate. That's not how things go. The point is to minimize the uncertainty, have a higher or most uh the highest kind of percent of probability in your favor, and go ahead and actually make money on that and capitalize upon that. Now, this is what we are attempting to do in a sense in this kind of webinar. Okay. So remember, there's no such thing as a perfect trade. As traders, we must come in terms of finding the most appropriate trade that has the highest probability for becoming a reality at that specific point in time. Okay, so we're picking moments across time that we find ideal for us in our eyes, in our point of views, and we make the best we can and take what we can from the pie, and then we move onwards. That is the approach in a sense. So trading at the end of the day is a game of probabilities. What we need to do is assess as many quantifiable parameters as possible, and there are plenty and we cannot cover all of them. But the idea here is to take them into consideration, analyze them, quantify them, and at the end of the day, come up with an actionable trading strategy and deploy it and execute it. Okay, so we are dealing with the first two steps here. So some examples that of tools that we have freely available at our disposal that we can deploy and use effectively in order to minimize this kind of uncertainty and risk is, for example, when it comes to trend identification, you're going to be looking closely at candlestick formations, either individual candlesticks or a series or a number of candlesticks together that at the end of the day, if you bunch them together, they create a formation or a pattern which has implications. We have discussed about the various different patterns that are out there. We have highlighted them in prior webinars. If you are unclear, unsure, or your memory is failing you and you don't have recollection of what these kind of patterns are, please go ahead and watch the webinars freely. It's on YouTube, it's online. Just go ahead and watch that, refresh your memory, and hopefully when time comes, okay, you're going to be able to properly identify them. And in a sense, at the end of the day, you're going to have that on the back of your mind, what kind of implications they have and what to expect from price action. So learning and studying is something that you need to do. Okay, so trend identification, we're gonna hopefully look at candlestick formations and patterns that we are easily identifiable, and it's gonna help us gauge what kind of phase in that instrument is, that kind of price action is going at right now. Also, another tool for trend identification, which is super simple as well, is drawing trend lines. Okay. No, we're not saying that if you draw trend lines on your chart, you're going to become a profitable trader. No, again, remember the purpose of trend lines. The trend lines are there to just visually illustrate what you already know. Okay, so by looking purely at price action, if the price action is making high highs and high lows and higher highs and high lows, moves in an upward kind of fashion, draw a trend line or not, the trend is moving upwards. Okay, so the trend line is there for you to visually have a visual confirmation, in a sense that the price action is heading that direction. It's a reminder tool for you to just keep an eye that where the market is headed at. No, it does not imply that if the trend line is moving upwards, it's an ascending trend line, the price action is moving higher and higher and higher. It doesn't mean that it's going to continue moving higher and higher and higher, and all you need to do is just go long and long. Okay, no, that's not what it means. It's just a visual confirmation. Okay, that's it. Okay, it may act as a support or resistance levels depending where the market is at and what kind of trend line you have, either an ascending or descending. May act for at specific points in time as a resistance level, if or support level, if it coalesces, or if it matches with other vertical, horizontal support and resistance levels. That's a different question. But the mere purpose of trend lines is just to highlight where the price action is headed, just for an easy visual illustration for you. Okay. Also, another tool that's freely and not freely available, everything is freely available. Some easy to use kind of tool that's indeed super helpful are drawing, mapping out, in a sense, or highlighting some point of friction, which is what we like to do anyways. So we look for these kind of points where the price action is failing to break above or below, or is finding support from. We call them, in other words, liquidity areas or liquidity pools, if you will like. So wicks of candlesticks can be used as such. For example, um, I've seen a lot of people use the days range in order to come up with a possible support and resistance area, and those kind of wicks are representing liquidity. So therefore, if you have on a daily kind of chart, the today's kind of trading range, the TR, if you would like, you map that out with the vertical line, support and resistance levels, and then you jump onto smaller kind of time frame and use that as possible areas of entering a position or exiting, depending on how the price action is behaving that day. Okay, so horizontal support and resistance levels are, from my point of view, the most, or one of the most important tools that you need to perfect when deploying to your chart. It's super helpful. It gives you, it's not merely for support and resistance levels. It can be used for many other things as well. For example, profit targets, entry points, and depending on where the price action is and how it is behaving around these kind of areas, you can get a lot of clues in conjunction with other data to come up with a much more accurate kind of prediction. Okay, so we also like to use other tools such as technical indicators to gauge momentum, volatility, depth of the market, and all that kind of stuff. Also super important, additional to the studying of price action in and of itself, but still those are supporting tools. We don't make decisions based on purely on technical indicators. We look at price action and technical indicators. So it's price, volume, and open interest, the three most important things you need to do. Technical indicators give you other kind of important kind of aspects of the trading instruments kind of price action or behavior, if you like, such as momentum, that we can gauge effectively and use that to our advantage only if we do a candlestick analysis first, okay, the price action analysis. Okay, so it's a supplementary kind of tool, technical indicators. Also, we're gonna be looking at assessing some sort of a potential impact of upcoming fundamental news releases. Those are dangerous if you don't know how to treat them right, or if you don't know how to interpret them, at least the results of these kind of fundamental news releases. We've have done a webinar in the past where we do cover this kind of fundamental data points that do affect price action by a significant margin and spark bouts of volatility. So you can do that and go ahead and revisit that kind of webinar and watch it once again and refresh your memory about this. So personally, I don't like to trade around news. The picture gets distorted even if you have a 90% confidence level on your ability to predict where the price action is going to head on a much longer time frame. Those kind of news events can distort the picture significantly. So trading beforehand and closing positions near fundamental news releases is something that I personally like to do. I keep an eye on those because they have distortion. Some people like to trade the news and get the rush out of things. I'm not a big fan. I like to capture um, larger portions of market moves rather than just scalp a news release. But if you like to scalp news releases, perfect. If that works for you, no fault. Nothing wrong with that. Okay. So other tools available to our disposal, super important, are take profit and stop loss orders. They keep you disciplined in a sense. So if you do make your plan and you come up with all these parameters and you analyze the parameters and you come up with prediction, and now it's time to let's just say jump onto the market. Before you do that, figure out where take profit and stop loss orders. You will place take loss and stop take profit and stop loss orders, and make the trade and watch it play out. Don't mess with these kind of things. If you have studied enough and said, okay, this level is the furthest away from price action that's going to go against me that I'm willing to take to endure, if you will, like, then just let the market do itself. Okay, I'm not saying not adjusting positions as time goes by. I'm not saying that. I'm saying come up with a take profit and stop loss in order for you to have targets. If you have targets, you know what to expect. If you don't have targets, you're just going through trading or with a much less sophisticated kind of approach or no accurate approach. I don't like that. I like to have specified pre-specified levels that I'm going to be comfortable with the price action moving close to or near to or at, and either taking a small loss or making bank. I like to do that because it makes things much more easier for me. I don't like to think a lot when it comes to the actual execution of the plan. I just like to execute it. The thinking part comes beforehand. Okay, so it's merely an execution. So coming up with these kind of areas or these kind of targets beforehand, it's a stress-free kind of situation. So you have the benefit of the ease of mind because you have thought about this beforehand. You're just merely executing, because at the end of the day, when you do actually trade and you are watching price action like a hawk, you get sweaty, you get nervous, you get anxious. So the more you do beforehand, the less you do at the execution phase, allows you to think things in a much more clear point of view, new things, I'm saying. So yeah, take profit and stop losses are super important personally for me. So I like to use them a lot. So it's a risk mitigation tool coming up also with a risk reward kind of scheme. It's also super beneficial. Money management is another. How much money are you willing to allocate per trade? You have a rule. Okay, is it 10% of your portfolio, of your equity, of your capital? Or is it 15? Is it 20? Is it 50? Whatever floats your boat. This is a subjective kind of question, depending on your risk tolerance, if you would like. Okay. Also, finally, instrument correlations are something else super extra, super extra, but still important nonetheless, because they help you assess potential impact of moves. So, for example, keeping an eye on the relationship between the dollar index and gold, or the dollar with bond yields, or the dollar with equity market. These instruments have correlations. They have, in other words, relationships. When one is moving upwards, most likely the other one is going to go the opposite way. For example, that's in the case with the dollar and Gold, so whatever you see, I thought the dollar strengthening, most likely you're going to see the precious metal falling. So keeping an eye on these kind of things is super beneficial. Okay. So, checklist, we covered this. Okay. Let's jump onto the live environment and see if we have any sort of opportunities we can look at and do these kind of analysis live together. So what is this? It's a dollar. Okay, so British pound against the United States dollar, major pair, sterling, the UK's currency with the United States dollar. So quote currency. Okay, perfect. So what do we see here? This is a chart I've prepared beforehand. You see an ascending kind of wedge. Price action moves radically between these two lines. We see a breakdown below this ascending trend line, if you will like, and the price action falling from there onwards. And what do we see here? It's a peak, so it's a lower high here. No, excuse me, a lower low, a lower high, a lower low, a lower high, and possibly another lower low here. So this instrument from the pound against the dollar from the 25th of September, so the end of October, start of October onwards, we have seen it losing a lot of momentum and is moving downside, possibly due to the dollar's appreciation. Maybe it has to obviously has something to do with the pound as well. So weakness of the pound, but the primary reason behind this kind of move since start of October most likely is attributed to the dollar's kind of strength rather than the weakness of the pound, and we can confirm that by looking at dollar index here. Let me mark. See, coincides kind of perfectly. So start of October, okay, onwards, you see the opposite kind of trend. Okay, you can clearly mark it like this. Okay, so the dollar has been strengthening significantly, and on the flip side of the equation, it placed a lot of pressure on other currencies. So most likely you're going to see the same thing with the Japanese yen. You can see the same thing with the euro against the dollar, and pretty much any other counterpart of the dollar since the start of October. Fundamental reasons behind this is possibly Trump's presidency. So before the election, we got a rally of the dollar in anticipation that the next presidential election will be claimed by the Republicans. Donald Trump is going to come into power. So the market's kind of rushed ahead of things, possibly due to other fundamental reasons as well, possibly a good I don't know, decent enough NFP print that says the United States economy is doing good enough. Also, possibly due to the Federal Reserve kind of remaining a little bit more hawkish and keeping, at least intending to have, let's just say, interest rates prolonged at a higher level and not cutting rates as fast as the market expects. And this can be a small reminder from this, which 18th of December, 2 days ago, we got the decision from the Federal Reserve, which actually did say that. So they expected, in a sense, that less cuts are going to come through in 2025. The market, the Federal Reserve at the September decision said that 4 cuts are expected for 2025. Now, at their December decision, 3 months later, they say, you know what, we do expect inflationary pressures rising from Trump policies. So therefore, we don't expect to cut rates by 4 times in 2025. We do expect to cut rates by only 2 times in 2025. So that's why you see this hawkish Fed tends to drive inflows towards the United States dollar because The rates are going to be elevated for longer than expected. That allows um, a creation of carry trades. For example, um, borrowing cheaply from Japan, borrowing capital and funds and money from Japan, and depositing them in the United States derived kind of accounts in order to come to collect this kind of interest. Because again, at the end of the day, um, net interest differentials between central banks do create these kind of trades, and that's why we continue to see inflows towards the dollar. Plus, for some reason, markets are forecasting that Trump's presidency is going to be super beneficial for the economy. It's going to um, make America great again, as he and his motto is saying. Okay, so the markets are believing that. That's why we see fund allocations in the dollar, and that's why we see the pound, as we saw the first chart, we saw sliding, and possibly the euro dollar is going to be the same thing as well. Okay, same thing, same momentum, same trend. So 1st of October onwards, complete opposite scenario here. So we do see euro weakness. Again, it's no euro weakness, purely is why is it not let me color things? Nope. Is possibly due to the dollar's strength. Okay, most likely has to do with this. Plus, Eurozone is not actually doing as best as it can. Right now, it's deep, deep, deep in a rut. So recession is possibly coming for Eurozone. So that's another way of telling you guys that possibly we're going to see this kind of move being extended further below, and maybe we're going to catch parity by January. Okay, parity meaning the euro against the dollar is going to be at 1. So exchange €1 to get $1, etc. Okay, so parity is something that we saw back in October of 2022, November of 2022. Okay, so yeah, nothing of surprise here. But let's go ahead and do the basic scenario construction kind of thinking process. But let's deploy this process once again. Okay, in this kind of case, let's do a trend identification. Let's just say we're going to start from, we've already marked it, so why not just go ahead and do that? So where is the market moving at right now? Where is euro dollar moving now? Obviously downwards since the 1st of October of 2024, when you get the renewed strength from the dollar, which pushed the euro lower. So this is clearly the direction of the euro of this pair since October. It's been 3 months now. Let's see now where possible areas of friction might be, where we're going to see price action rebounding from. So remember what I said about range. Look at this. This is super nice. Okay. You can use that as a valid support level. So bottoming out of this kind of candle, let forward for at least temporary for the time being rebound. Okay. So we're going to mark this area as support that we're going to keep an eye on. So what else? What kind of areas we can deem as a valid support level? We have to go way back. So maybe this is another one. Maybe this one is another one. Okay. So areas of friction, or where the price action is rapidly pulling back and rebounding from. So that's an area that I'm going to be looking at. Lovely. Okay. Yep. That's good enough. Maybe somewhere in here. So remember, this is not merely lines, this is areas. So you'll be just highlighting these kind of potential areas that we may see price action rebounding from in the near future, or falling and impeding the bears, because the bears are in control, impeding the bears kind of progress and pushing price action to lower ground. Okay, this one is another one, but much closer. It's going to be maybe this one. Okay, so we have highlighted a few potential areas where the price action may find support in the foreseeable future if this kind of situation continues. Okay, so the lowest point is 103. Okay, that's decent enough. Let's just round things up a little bit just for us to be able to communicate much more easily. 1.03, that's okay. What else do we have here? Let's go 102. Let's just round things up in order for us to have. Okay, so this is parity. Okay. Roughly speaking, those are a few areas that we could expect the price action to fall towards too. Let's just say for the time being that this level we're currently at is going to be a strong support level for the future of dollar with the euro against the dollar. So let's just say the price action possibly could reverse and move upwards and break above this kind of descending channel. Where are the possible areas of resistance that this price action may encounter? Okay. My eyes is going to be this peak that we've fallen below from. So I'm going to mark this area. I'm going to highlight this area. Maybe another one from the past. Yeah, kind of coincides with this kind of consolidation mode area here. Another one is going to be up there. And possibly somewhere in here as well, because you can clearly see this kind of being, it could be extended. Okay. Mark it like that as a possible resistance kind of, or a valid friction point that you expect to come through in the next, if the price action moves higher anyways. But we are on a daily kind of chart. Let's see what we can do further with this kind of information. So we marked some possible areas where the price action can rebound from and find resistance at. So let's go ahead and do the same thing, just round things down or up. So 106, lovely even number. No, even, it is an even number, but still. 1.052. Okay, so we have a few areas of how we can, of where the price action could move towards to next. Okay, guys, if you have any questions or if you like me to look at any other instrument, please let me know in the chat. More than happy to do so. But for the time being, because I don't see anyone making any complaints or asking any questions, I'm gonna continue doing my thing. Okay. So we have identified where the market is headed at, or this instrument, excuse me, is headed at. Downwards, clearly you can see downwards moving channel. Maybe it's not for you, it's not, could be, maybe you will not brand it as a descending channel, fair enough. Clear as day is, however, where this instrument is, excuse me, moving at is not doubt about it. So obviously our bias is going to be bearish. Okay, clear as day. What are our technical indicators telling us? Okay, let's discuss. Okay, so we have, as you can clearly see, the 12 period EMA and the 26 period EMA. Okay, so moving averages, exponential moving averages, one for the period of 12 days, because we are on a daily chart. So, and the other one is 26. Okay, so the long and short, we see the crossover between the two. So the short term, quote unquote short term. So the 12 period EMA, the black line, has crossed below the 26 period EMA back in October. And that was a signal that the trend has shifted. No, is shifting, has shifted already. Okay, after the breakdown has happened. So we have here what we call a death cross or a bearish cross, confirmation that the price action is headed towards the south. These two lines have stayed far apart for the duration of this kind of move. So that's one indication telling me, you know what, trend is moving downwards. Why not? Why bet against it? I'm going to continue having this kind of assessment as well. So bearish call or bearish signal given by the two moving averages that we have. Third clue that we are on a bearish kind of moving territory or downwards moving price action is, as I just mentioned earlier on. Let me highlight it yet again. So we have a higher low here, a lower high, excuse me, a lower low here, a lower high here, a lower low, a lower high, and another one. Okay, another one here. Okay, so clear indication that the price action is moving downwards. What my other technical indicators telling me? RSI, is it below 50? Is it between 30 and 50? If yes, which it is, the bears are indeed in control, pushing price action to lower ground. You can clearly see that currently we have a blunt RSI of 36 and a moving average based RSI having a value of 40. Definitively the price action, excuse me, definitively the RSI is confirming that. So bears are indeed in control. However, we're going to look at a possible divergence if there is any. Let's make an assessment. Okay, oversold, overextended levels back in the 23rd of October, a rebound, but yet again, price action moves to lower ground. Okay, so maybe we can deem this as the same area. So bottoming out of the pound against the dollar in regards to the RSI reading. So nearly around the same time. However, price action continues to move downwards. So lower lows, okay, and lower highs. RSI is recording the same value, okay, irrespective of the price action. Okay, so that's something else we need to pay close attention to because we spotted right now a divergence. This area, we see price action bottoming out and finding support from here. Okay, so the same level. Okay, price action fails to break below the 103 area, if you would like, and attempting to rebound in today's session. What is the RSI doing? Has consolidated and rebounded from a higher level compared to the prior one. So this is an early sign of divergence. Maybe this kind of rebound is going to be strong enough if and only if we get enough resolve from the bears. Do we see enough resolve from the bears? Do we see enough momentum? Let's look at other technical indicators that we have available in front of us. AEDX, okay, it's going to give us the strength of the trend. The positive AEDX is currently around the 40 mark, which is signifies strong enough kind of move. Negative DI is clearly far apart from the positive DI, so the difference between the two, so it's something like what, 21 units, so it's a lot. So 27, the value of negative DI, definitely broadcasting to us that the bears are in control. Negative interest is stronger than positive interest. So positive DI, positive directional index, has a value of 8. So that's telling you which is actually diminishing. So in this kind of area, we had a positive DI of 14, 15, and now we have seen a slow deterioration of it. We're down to what, 8? So halving of that. Maybe that's why we see these kind of strong moves against the pound. The bearish momentum as well, the bearish strength has been weakening as well, but during yesterday's session, on Tuesday session when we had the Fed's decision, we see a spike of negative sentiment yet again of selling interest sparking once again, which is telling me, you know what, maybe we're not going to get some sort of a reversal here, but let's see, we'll see. Also, the moving average convergence and divergence, the MACD below, MACD-V actually. What is it telling me? So we have both the signal line and the MACD line in negative territory, okay, clearly below the threshold of 0, okay. Both the MACD line and the signal lines are in negative territory. That means, in other words, it's bearish momentum. The bears are in control, pushing the price action to lower ground. And also the MACD is below the signal line. So the red dot you see there is a crossover between the MACD line and the signal line. So the MACD line crossed below the signal line, creating this kind of negative signal. You see negative prints also from the MACD, telling me once again that the bears are in control. So the reason why I have highlighted, everything tells me this is bearish. The reason why I've highlighted this kind of area may be acting as support, is for us to use it to our advantage and extrapolate that if the price action, when the price action reaches this kind of level, the 104.2, let's just say, I'm going to be looking closely of whether the price action is going to break above from and with what kind of resolve, or if it's going to stall. Okay. Ideally, we need to see it's for us to trade with the trend and not go against it, is for us to see price action failing to break above this kind of level and returning yet again closer to this to challenge it once again. So this is what I am expecting. Okay. So therefore, if the price action, we can play this with a different kind of, we can have many different approaches to this. I don't like to have biases in the beginning, but I'm reading the market. I'm seeing what the price action is telling me. From there onwards, I like to adopt a much more kind of liquid or fluent kind of approach. Whatever the market gives me, I'm going to trade based on that. So I'm not going to say, oh, you know what, this is bearish and the only position I'm going to open from now onwards is going to be short. You can do that, but I like to be much more relaxed or much more fluent when it comes to choosing how to approach this kind of thing. Okay. So I'm making scenarios on what would be reasonable enough for me to play this kind of trend. Okay. So everything is telling me bearish. Okay, fair enough. If I'm gonna go short, I want to see price action. I'm gonna see, sorry. I want to see the price action heading up to this, the 104.2 level, and failing to break above it, and then turning downwards. Forming, in other words, a lower high. Okay. So the higher that is, the better. But if it's at that point of that area that I've highlighted, then that is all I'd like to see. Okay. And then I'm gonna go ahead and place a short order, something like this, risk that much in order to get that. Okay, so I'm going to use that as my stop. Maybe it's going to be a little bit up here. I'm going to give it a little bit more room. So my stop is, I like to be around the 104.3. Let me highlight that price. Where is it? Stop level. This is what I'm comfortable with. Okay, I'm going to give it that much room to gyrate around. If it breaks above that, perfect. I'm going to have a loss and then I'm going to move onwards. But ideally, if it does fail to break above it and we see price action breaking below this kind of level, failing in a sense to rebound, I'm going to be, I like to go ahead and do this. So if it breaks above this kind of area, the 104.2, and also the descending, the upper bound of the descending channel, I'm out. More than happy to take 3/10 or 4/10 of a percent of a loss and move onwards rather than just wipe out an account. Okay, so that is my ideal trade in a sense. So I'm going to be risking. I'm going to go short in this kind of environment if the price action fails to rebound or gets closer to the upper bound of the descending channel, if you will, like, place a short order and have an expectation that the price action is going to break below this kind of level and continue downwards. And I have a target preset before the 1023, which is, let me see if it's an accurate one or not. Okay, yeah, the one we set earlier in the beginning. I like this one area. I expect that some sort of a struggle will take place between the bulls and the bears there, much like it has down here. So this is my next stop, if you will, like, the next route, the next destination. So I'm willing to lose almost 0.4% by again gaining 1.5%. That's a very nice risk reward kind of trade expectation for me. Okay, this is ideal for me, but I need to see the price action failing to rebound strongly from up there upwards and the price action remaining within the two bounds of the descending kind of channel. Okay, this is what I like to see in order for me to be the ideal trade to go short. Okay, now if the price action does much more than that, okay, and if it's much stronger than that, and for some reason this support level was deemed by the bulls as the last stand, if you would like, of them for containing the deterioration of the pound. If that is the case, I would like to go long. Let's just say from straight where we are, have a stop right there, okay, at this kind of area that I know it has, let's just say, held so far, at least one, twice, three times so far, maybe four times, okay, within 4 different occasions. And I would love to have a target, something like that for my exit. Okay, so not as good risk reward ratio, mainly because we spotted this kind of rebound later on in the day, right now, essentially. So if I had the chance earlier today and I made this kind of scenario at that point in time, maybe my entry point would have been here. Okay, which now we're on an hourly kind of time frame. Okay, which would have switched or changed my risk reward ratio from 2 to 1 to 3 to 1. Okay, so that's perfect. But we missed the move, so we are assuming that we are going to enter the position right now. Okay, so we have a risk reward ratio of 223. Okay, still decent, but not ideal. At least for me, it's not ideal. Okay, might be for you. I like to take more than close to, definitely north of 2.5 and possibly 3. More than that, I like to do this. That if it doesn't have this kind of risk ratio, I'm not bothering to go into a trade. Okay, so I'm not, because I'm putting my money at work in a scenario where the risk reward ratio it's not as ideal. So that's gonna take much less capital for me. I'm gonna allocate much less fund that I originally do when the risk reward ratio is calibrated to my needs. In other words, that's what I'm trying to say. So for the time being, we can extrapolate that given this divergence that we have seen, which is the only thing telling me that the price action is possibly going to move higher, All the other indications telling me the bears are in control. They're going to push the price action to lower ground. For example, this is the second scenario. I'm making the assumption, or I'm expecting the price action to rebound from this kind of level and hit that kind of target purely on the divergence and kind of data that I have in front of me. Where's going to be my target? Right there, where we have seen the price action falling from. Okay. Once again, I'm willing to lose half of a percent in order to get 1.2. Okay. No ideal, but still decent trade that you can actually place right now. Okay. So not expecting the price action to fail to break above that and go short. Okay. I'm giving you two different examples of how to approach things given the information I have in front of me based on the assumptions and the analysis that I have done so far. Okay. Hopefully this has been informative for you guys. Guys, do you have questions? Nope. Unfortunately, this brings us to the end of today's session, guys. Well past our time. Thanks for watching, and hopefully we're going to catch you on to the beginning of a new webinar series. Going to start in January. For the time being, enjoy your holidays, enjoy Christmas and New Year's and all that kind of stuff. Hope you're all doing well. For the time being, take care. Bye-bye. Ciao. Trade safely. Okay.